Welcome to the CTI Starter course. So what we're going to do, Intro 2, is take you through styles of technical analysis. So really delving deep into the charts. If you remember back to 1, when we went through all the different terms, the order types, what Forex is, looking at what candlesticks are, all the sort of basic information you need, this is an extension onto that. So we're really going to get into the meat of the course now. And if you remember the candlesticks that we learned, I used the term price action before. Price action was the movement of candles on the chart, so the pattern of price. And these tools we're going to learn in this chapter are things you can apply to the chart to actually make sense of that and take sort of predictions of things that may happen in the future based on past price action and past price patterns. So the first type of analysis we're going to learn about is the really kind of basic things that then the other tools will go on top of but relate back to, and that's support and resistance. So support and resistance, let's start by looking at what is support. So this term is the basic element of technical analysis. It's like the most popular kind of terms that you may hear when you're going through your trading career. And if we look at what support is, think about A, B, C. So here's our downwards A, our B correction, retracement, pullback, C continuation, that next momentum leg to the downside. Let's say the price moves away, comes back down again, price moves away again quite strongly. If you notice that when the first wave, when we look back at this wave here, we made a new low, right? So price came down, it retraced, it pulled back a little bit, and then came down for the next momentum leg, which is the C, and broke through the previous low, creating a new low. And then we come back for a B. You might think, well, it's going to make another C. It's going to break below this low and continue that downwards trend. But it reaches roughly where the previous low was and bounces away quite strongly. So what we're doing now is creating a level of support. We come back down here again, and the market gets pushed away yet again. So something is down here. There's something at this rough price area that's supporting the market. So think of this as like a floor, or if you're throwing a football or a ball at the floor, it's going to bounce away from it. So this is like the floor of the price where the market keeps bouncing away from and being brought back up again. So therefore, if the market is moving downwards and it's hitting this area and moving away, it's known as a level of support. So in this example, it's kind of moving quite erratically. You can see that the highs and lows are in different places, but there's still an area that's just not able to break through. So on a real chart, we can see that there are levels here, well, there are lows where the market struggles to break. And notice that it's not exactly in the same place, right? So we don't have like one exact price or one exact line. It's a zone. So it's a support zone, a support range. And you can see where we are right now on the very right-hand side, this one here. The market is coming into it, so we don't know what's going to happen. It could break, it could just go straight down through, or it could bounce again. But we need to know what's here, and obviously we can box this off and say, right, this is a previous level of support. The market has been bouncing away from here previously. Think of the football again, it's being thrown against the floor and bouncing away. And each time it reaches that extreme low, it's like the equilibrium point, where that ball at some point does actually stop and stops its movement before it then bounces back up again. So what's going to happen? Is it going to break or is it going to bounce away? Well, that's obviously something you need to wait for. But this is an area the market turns from again and again, therefore an area of support. So what causes support? We need to think of like what's behind the scenes in the market that may cause this to happen, to occur. So here are those previous sort of ABCs that we looked at, but just slightly different, a little bit less erratic. So if we look at this price, the low here, let's say it's 1.01440. It could be anything, of course. If it's a yen pair, it's going to be maybe 111 spot something. But this is the rough price the market keeps turning from. Here's the initial low. So of course, at this point in time, when the market moves away, you may be thinking, well, it's coming back from the B and we'll make another C because you don't know this is going to happen yet. Comes down here again and bounces away. It's now formed two lows roughly in the same place. So remember, with a candlestick, you have wicks where the extreme low is also shown as well as the close. The wicks could be below or above the previous low, but it's kind of in the same place. It's never really going to be exactly the same. Comes down again, forms another potential low. Now notice I said potential because you don't know whether it's going to break above or break below or just bounce away again to the upside. So each time the market reaches roughly that price, there are buyers coming into the market, because there's an imbalance of buyers and sellers as it moves down and back up again. And as it reaches that price, it sort of like becomes equilibrium because you've got huge selling pressure coming into it. And of course, there's going to be a point where where that ball stops, right? Where that ball stops as it's bouncing away from the floor, and when selling and buying reaches the exact equilibrium. And at some point, maybe the sellers, stop selling, that they start to give up, or they start to buy back their positions. The buyers are seeing that the market's a decent discounted price for them, and therefore they start to increase their bids again, lifting that market upwards. So it's really the imbalance of buyers and sellers switching from lots and lots of sellers, not many buyers, to then lots of buyers and not necessarily many sellers. So that's what's sort of happening down at this level. So the demand here is outpacing supply. So again, remember the last chapter we looked at supply and demand. So supply in the market is when the market is being pushed downwards. There's lots of people offering that asset, lots of people selling into the market. And when the demand steps in, when those bids come back into the market, it lifts the price. So here at this price, you have demand outpacing supply. So what's resistance? And if we looked at support, you can flip this around, and now we think of resistance in the market. So it's the ceiling. So there's an a B, and a C. So what you have now is a sort of completed bullish ABC wave. You come back down for a correction, you might be thinking, right, it's now time for the next leg, the next momentum C. And what happens is you come roughly to the previous high and start to move away quite strongly. Well, something's happening here. There's clearly an imbalance going on roughly at the high, but then the sellers are stepping back in where they previously stepped in. So when you look at this leg here, when it reaches the previous high, there's just not enough selling to stop it. It just keeps going. But this time there's a lot of selling there again, pushes away, comes back again. The market is moving in an upwards direction overall, but it's hitting a ceiling that just cannot seem to break through. And that's it. So it could be any price, whatever pair you're looking at or asset you're looking at, but it's roughly in that zone of price. So therefore, it's a resistance level. It's the ceiling. As you throw the ball into the ceiling, it stops at some point. Equilibrium is reached between those buyers and the sellers. It gets pushed back down again. So here's a chart example of that. So if we look at where these highs are coming in, there's the first high. There's a second high. You could say there's a third there. There's a slight dip before we see that high, and a fourth one over here. So if you notice on the right hand side on this fourth one, that high, so the high of the wick of that candle, actually breaks above all the previous highs, but it only breaks above, doesn't close above. So the end of that candle, it could be a 1 hour, a 4 hour, a weekly, whatever it's going to be. The actual close is back down below the previous highs. So let's say halfway through the candle, let's say it's an hourly candle, and 45 minutes through, that's when it's at the high. It hasn't actually broken through yet because that candle's not closed. So sort of a little side lesson is always wait for candles to close before you actually take action on that candle. So it ends up closing the hour back down below. Therefore, we've sort of probed into resistance. We've gone into those orders where the previous highs were, but then being rejected back down again, closing below resistance. So again, it's just another high in that resistance area. So on the right hand side of the chart, it goes off into oblivion. You don't know what's going to happen there, but if the price reaches that area again, it's an area of price that you need to watch, because clearly things happen there, right? A lot of selling happens in that area. So that's a sort of wide-ish zone. Now that's an area of resistance as the market keeps turning away. Therefore, opposite to support. Support is the floor. Resistance is that ceiling. So what causes resistance? Well, it's the same as before, but opposite way around, of course. So here are demand and supply. There's a lot of demand in the market. There's a lot of bidding the price up. Some selling pressure comes in, reverses back to bidding again. But at this price, let's call it one spot 4,560, the selling just outpaces the buying, right? So the supply is outpacing the demand at this point. So there it reaches equilibrium and then perhaps turns back away again. So there's too many sellers up here that the buyers just cannot seem to push it through. Supply outpacing demand. So what happens is there's a phenomenon that happens in markets very, very often, where resistance becomes support and support becomes resistance. So we're effectively flipping these levels. So if we look at this example, you've got a bullish market coming up, A, B, C, that's C, then becomes the next A leg of the next wave, B and C, but the C doesn't quite break above, it kind of stops roughly in the same place. So what we're forming now is resistance, right? You can see that the market is struggling to break above, supply is outpacing demand up here, and resistance is being formed. Now this happens. So at some point, that level may break, and here it does. So you now have a big A momentum leg in the market. It comes back down to where? To that level. So if it comes back to the previous level of resistance, that may flip and become support. So essentially, this is a phenomenon where resistance, once broken through and maybe gets tested on the other side, can become support, and of course the other way around as well. So once resistance is broken, it can become support, because it doesn't always. It could just continue going forever, or it can just slam straight back down through again. But a lot of the time, it can become support, and of course you want to be watching that as a possibility if you're trading a pair that happens to be looking roughly the same, where you do break through a level and it starts to come back down. You need to mark that level out and see, this could happen there. And you look for signs that could be happening. So support can become resistance too, because of course it's, whatever happens on the upside also happens on the downside. So as that floor gets broken down through, you throw the football so hard and the floor breaks down through, maybe it bounces somewhere, comes back up again. Well, that's now the ceiling. So here we have the ABCs to the downside, stops where the previous low is, pops back up, back down, back up again, and then breaks down through. Well, now we have a previous level of support that could potentially become resistance. The market comes back up again and hits that level, and it could, of course, move away. It could come back up and just smash straight back up through again. Or maybe this just keeps on going. It doesn't even pull back to that level. It doesn't come back far enough, but it could do that. It's definitely something you want to watch for. So therefore, once that support is broken, it can then flip and turn into resistance. So if we look at a chart example of this, well, here you can see on the left-hand side, so first off, focus on the left-hand side, where you have those three highs. So at some point, those three highs do break above. You can see the huge, the big white bullish candle that breaks through those highs. And as it comes back down to retest on the other side, you form support. So look on the right-hand side, you've got those three arrows where the three lows are, and they're roughly coming back and testing the same area as the highs were previously. So where there was selling, those sellers have now given up. The market comes back down again, and the buyers step back in at the level, because that's seen as like an area or a sort of zone of the fair price, and they want to add the bids back in again. Or maybe those sellers are now in a loss and they want to buy back their positions for roughly break even. So they add buys into the market to do that. So of course you can see market found resistance, broke through, came back into the area of price. Now if you look to the right hand side, the very, very right, it does break through again. So it does break to the downside. So these levels don't last forever. Sometimes they may break through. So you can imagine that on the right hand side, if price starts to come back to that level again, well, it's the same story. It was resistance, it became support. If it breaks down through again, it could become resistance again. So you can see how it works. These levels don't tend to expire. If you have very, very important levels like this, let's say this is a weekly time frame, then this is going to be an extremely watched area, because participants on all time frames will be watching this rough zone. So of course, if we come back into it again, you may see interesting price action there across all time frames. So that's what support and resistance is. When we go through the tools later, we're going to see that a lot of the tools relate back to this idea. This is like the basic idea of technical analysis. This is what actually exists in the market. Then when we look through other tools like trend lines, Fibonacci, ranges, they're all sort of other different types of forms of support and resistance at the end of the day. So make sure you really understand this, and I'll catch you on the next section when we'll look through the variations of this and placing tools onto the chart.